back to another episode of Investments in Focus. Today we have Chris Wood with us from Revesco Properties. Chris is a trustee for the Revesco Properties Trust, and he will be discussing their current offering. If there's any questions following the presentation, I encourage you to reach out to your private wealth advisor. Chris, I'll let you take the reins.
Thanks, Darren. Thanks everyone for taking time to hear our story. This is an easy story for me to tell. It's my personal career, and I'm going to try and keep it short and sweet. As always, if there are questions after you get through this, please reach out to your private wealth advisor. We are making ourselves very accessible to them to answer any questions that you may have. So just run you through a bit of a deck here. Revesco Properties Trust has come out of a 30-year career that I've had in commercial real estate with my partners. It's a bit of a Vancouver story. And as I said, it's a pretty easy story to tell because it's my career. So Revesco was started a dozen years ago by what we call the three amigos, Rhys Duggan, myself, and Scott Lee, whose photos you see up there. We were all friends from university here in Vancouver. Scott and I met at the University of British Columbia, where we graduated with commerce degrees in real estate. Rhys Duggan went to SFU, where he's got a business degree. And we all got into the commercial real estate market in the early 90s. Rhys actually moved down to Denver, where he had an extensive career in development with a company called Southwestern. They would take large tracts of land, subdivide them, and sell off lots to individual home builders. But they would keep the tracts of land to build shopping centers on, stuff that we're going to talk about today in Revesco. Scott and I both got into real estate brokerage. I work for a company that's now Cushman & Wakefield. Scott worked for CBRE, and in 1996, we came together and started a company called Northwest Atlantic. So Northwest Atlantic was a tenant advisory firm, and if you've pretty much shopped anywhere in Canada, you shopped at a shopping center that Scott, myself, or our team transacted in. So if you think about Walmart, Nordstrom, Target coming and going from Canada, shopping at a Winners, Marshalls, HomeSense, etc., going to a movie at Cineplex, that was Scott and I. We actually grew that firm to 55 people in 3 different offices, and that really led us to the creation of Revesco. Revesco was a platform that was started for Rhys, Scott, and I to invest our own funds alongside investors' money into the space we knew really well, which is open air retail. Early on, we passed the hat around to high net worth individuals and some investment advisors to raise capital. And the feedback we got over time was investors wanted predictable income with upside. They wanted access to a portfolio with a qualified sponsor. That led us to what we're going to talk about today, which is Revesco Properties Trust. It's an open-ended Canadian mutual fund. It pays a quarterly distribution of 4 3/4 to 6%. We've made every distribution since our inception 5 quarters ago. And it's kind of interesting being the new kid on the block when you've got as much gray hair as I do. So if we take a look at the team, we're based in Denver. We have now 16 people on the ground there, 4 of us, including myself, in Vancouver. That building you see in this slide is a purpose-built office building that we built for our team. And, the reason I bring this up is I'm super proud of my team. We've got expertise in all of the asset classes that you see on the right-hand part of this slide, whether it's acquisitions, development, asset management, property management, leasing, financing, and marketing. So that's a big part of it. Our money is in this venture. Our team is solely dedicated to what we do at Revesco. And I think every investor needs to know that you've got a qualified team beside you. So the composition of the fund is 80% in income-producing assets, predominantly in open-air retail shopping centers or mixed use. That plays to our strength. Our strategic advantage is our knowledge in retail. A couple things that's worth noting here. This fund is all US dollar denominated, US dollars in, US dollars out, distributions all made in US dollars. A couple things that Revesco Properties Trust is not. We are not in the enclosed mall space. That is a completely different world. And it's very simply put, as soon as you put a roof over it, you have to heat it, cool it, pay taxes on it, insure it, provide security for it. And it makes it a completely different environment than going to your typical food anchored center or power center. And that's the space where we know very well what goes on. So once again, back to the fund composition, open air retail shopping centers and mixed use. Just because good retail has some apartments or office above it, that is a space we're really comfortable in. And then the other 20% of the fund is in what we call the opportunistic bucket. So buying some existing debt, participating in some developments, anything that's going to be accretive to the returns that are stated at the bottom of that page there. So as I alluded to earlier, we've made every distribution since our inception. Depending on what share class you are, the distribution after fees is 4.75% to 6%. Our targeted annual return is 10 to 14. And I always get asked the question, how do you get from 4.75% to 6% to 10 to 14? Simply put, it's broken down into a couple different components. Just like your home, every month that goes by, we're paying down principal on our mortgage. The other thing is we're bringing our development and leasing expertise to the table. We're leasing vacant space, we're restructuring existing lease deals, or we're adding development density to a project. The last piece of the puzzle is every time a mortgage rolls, we're looking for better terms from the lending community. And once again, I've come back to it's a US dollar denominated fund based out of Denver, investing in US assets. And as much as commercial real estate is very similar in the US, it's also got its nuances that are different. In a lending environment, there's 100 times as many lenders in the United States as there are in Canada. This gives us more competition, better rates, better flexibility in our mortgage financings, and way more access to product. So we strongly believe the fundamentals of our space have not been addressed in the last decade. The US has had too much retail per capita, but there's been very limited building of new retail in the US over the last decade. And that equation of supply and demand for open air retail space is in a very good place with your overall vacancy rate in open air retail in the States below 4%. So what does that mean for us? If we can see more product and we can buy it in a more competitive environment on better terms and finance it better, we're going to have better returns for ourselves and you as an investor. The last piece, which is down here in the bottom right, is our money is right beside every investor's. We're in for 10% of every equity raise, up to 5 million US, at which point in time we have to take a look at our capital stack. But I think that really proves our alignment with our investors in this venture. So that's an overview of the fund. Once again, you've got a qualified sponsor in Revesco with our team. We're really only buying from highly motivated sellers. One of the things that I think a lot of people are concerned about today is the R word, recession. What that means for us is the silver lining that we are seeing in the marketplace every day is that properties that are coming to market aren't coming to maximize returns. They're coming to market because they have to. You've got a broken partnership, you've got a REIT that needs to rebalance their portfolio, you've got a mortgage that's rolling that is at much different terms. And what does that mean for Revesco Properties Trust? We're buying in at a much more attractive basis, and that allows us to grow returns over time. I always get asked about the internet and the effect of it. Everybody's heard about Amazon and online sales. And this is where I love the conversation. I'm a self-professed retail geek, but pre-COVID, we had no idea where online sales were going to be. At the peak of COVID in the United States, only 15 to 16% of all sales in retail were done online. That number today is below 12. What does that mean for the bricks and mortar space that we're in? The store has never been more important. Bricks and mortar retail is not going away. It's critical. People order online, pick up in store, order online, return in store, order online, pick up curbside. What's the common element there? The store. The bricks and mortar store is not going. Once again, we're based in Denver. The target markets that we've identified on this slide are markets that we really like. The demographic fundamentals and the employment base are very sound and very diversified. But the two common elements are they're growing in terms of population and income. That's very self-serving for our space because it's good for retail. The more people you have with the more disposable income, the better it is for our shopping centers. So we currently have a number of assets in the fund. We have assets in Phoenix, Flagstaff, Fort Collins, which is just outside of Denver, and Bozeman, Montana, as well as Louisville. Everybody's heard about the Kentucky market or the Kentucky Derby, but I love Kentucky. It's affordable, it's growing, it's a great lifestyle state. And a lot of the markets that we look in are often overlooked by institutions, meaning I'm not competing with somebody that can, just bid up the price of an asset. This is really what I call our money slide. This is where we actually are able to make better purchases and have better information to make better real estate decisions. With Scott and I specifically having 30 years in the retail leasing space, we have strategic relationships that most buyers do not have. As I cited earlier, we were involved in bringing Target to Canada and then taking them back to Minneapolis. We are able to pick up the phone and get real-time information about how a store does for any one of these tenants on this screen and multiple others. The biggest thing that I always say is I never want to buy a problem. So if a store's not doing well and it's on a store closure list and you don't know that going in to buy a shopping center, you've bought a problem. We will never do that. So this is key. A couple other things I would highlight here is not only do we have great tenant relationships, we have great relationships with a number of lenders, and a lot of our deals come through brokers. And having spent, 30 years in the brokerage community, we've got a lot of deep relationships that bring us deals each and every day. This is a lot of text. Your investment advisor can go through it in terms of different series, how it all fits in. Our fee structure is highlighted down here at the bottom, very standard for commercial real estate. Our MER is, roughly 2%, and you can get into details with your advisor on any questions you may have here, as well as on our structure. The key point that I like to make here is that this is a Canadian mutual fund trust. What does that mean? The everyday investor does not have to file a US tax return, right? No one wants to file a US tax return. And this structure is tried and tested. It's been around for almost 20 years, and you do not have to file a US tax return. This is just an example of some of the assets that we've got in the fund. I can skip forward here. Here's a summary of where the fund is today. We've got 5 income producing assets. We've got 2 financial assets. Assets under management are just shy of $100 million, representing about $45 million. Once again, all figures US of equity. We are seeing great deal flow and great opportunity to buy quality assets at a low replacement cost. So, the fund's in a great place, and we're looking to grow with everybody's assistance. So I'll stop sharing there and really appreciate you taking time. If you do have any questions, please reach out to your advisor, and I'll be happy to interface with your advisor and answer any and all questions that you may have.
Awesome. Well, thank you very much, Chris, for the presentation. Again, just empathize what Chris said. If you want to learn more about the offering, or if you think it might be a good fit with your portfolio, connect with your private wealth advisor and they'll be able to discuss it with you.